But I think this is the quiet before the storm. And I think we might be coming up on a really unhealthy year end for everybody trying to get their sale and 1031 exchange and acquisitions in before the end of the year, knowing that they may have to keep their property for decades if they don't.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, what's the good word?
So, Eric, it's a really interesting period right now. We're real estate brokers, and, we've seen an uptick in all types of real estate, and particularly triple net and investment properties, and we manage in our property management some of these properties. And there are caveats. There's things that some of the owners have to do in order to really get maximize the yield from these investments.
Well, most people buy single tenant net lease properties, which is what we're going to be talking about today, because they're pretty easy to manage. They're referred to by some people as mailbox investments. Essentially, you get a check in the mail and there's not a lot of tenants, toilets, and trash, which is significantly true comparing it to an apartment complex. But we actually manage a number.
I have to interrupt you 1 second. I like that. So we're talking about triple N properties, and you brought as the contrast the triple T properties.
The triple T.
Tenants, toilets, and
tenants, toilets, and trash.
Okay,
yeah.
I like that.
Yeah. So the triple T properties, a lot of folks will eventually want to move away from them because they are very labor intensive. But you might ask, why would anyone manage a triple net property? They're so easy. Well, they are, for the most part, very easy. What becomes somewhat problematic is at some point at the end of the year, beginning of the following fiscal year, you have to reconcile the CAM and send it off to the tenant, and their national office has to check off, and that can be somewhat onerous. So we do quite a number. We have FedEx, Baycare, Amscot, T-Mobile, AT&T, Starbucks. So, we do a number of these, but most of it is for the CAM reconciliations with the tenants at the end of the year, which can be somewhat complex. And they rather it's cheaper to have us do it than have their accountant do it, who really doesn't understand the real estate.
And it can be significant to the investor, the fees they recoup or do not recoup.
Oh, yeah. Yeah, we did one recently here that was about $20,000 difference. We got brought on and realized that they had been undercharging $20,000 over the course of about 5 years. So anyway, it's really great that we're going to have a guest to talk about triple net, because it has been a subject that our listeners have wanted to hear, how the triple net investment single tenant deals work and what's going on in the market. So we're really happy to have a guest on that's going to talk about that today. But before we get rolling on, I would like to read a review from Fernando at Miami through the Apple Store. He said, "This is one of my favorite podcasts in commercial real estate, informative, great guests, and nice to listen to. Highly recommended for anyone in commercial real estate." Hey, Fernando, that's much appreciated. We try to talk about this as little as possible every show, but it is really important that if you've not given a review, please do, because we get great guests like Alan, who is getting ready to come on the show and talk about, they want to look to see, are we relevant in the market? What kind of work do we do? Is it align with their goals and objectives to invest their time with us? And so when guys like Fernando leave a review, it helps us immensely. So if you've not done so, we really appreciate you go on to the iTunes store and leave us a review. Even going on to the website, leaving comments is enormously helpful when guests are researching whether they're going to come on the show. Steven, anything else that you've got before we get rolling in with our guest?
We have to roll right in before the market changes. Today we have with us Alan Fruitman. Alan is the president and managing broker of the Real Estate Foundation, Inc., also known as 1031tax.com. Alan helps investors and 1031 exchange buyers purchase single-tenant, triple net, and double net leased property. Alan has written a book called The Triple Net Property Book for Buyers of Triple Net Leased Properties. Alan, welcome to the Invest Property Show.
Stephen and Eric, thank you both. Nice to meet you.
No, we're pretty excited to have a single tenant guy on the show. We talk about it. When I first started out with my own brokerage, I was actually doing some development of single tenant Starbucks properties and brokering those. But obviously we're full service brokers now, but it's been tough trying to get someone on the show to talk single tenant. So a lot of people ask questions about it. So, Alan, we're really excited to hear what you have to say today. Why don't you start sort of telling us how you got into the single tenant world?
Well, I'll give you the short version of a long story. Way back when, 29 years ago, I was selling residential real estate, and one of my clients, I sold a rental residential property for them, and they asked me if they could 1031 exchange into a CVS pharmacy. And at that time, I didn't know what a 1031 exchange was, and I didn't know what a CVS pharmacy was. So I told them politely I couldn't help them, but I quickly learned what a 1031 exchange was, and I learned what a CVS pharmacy was. And I had this thought of, wouldn't it be nice not to sell one house at a time when I could sell 5 or 6 houses for the same price as one CVS pharmacy? And fast forward a few years, I left residential real estate and focused entirely on single tenant, triple net lease property, and mostly 1031 exchange buyers. And since then, I've sold several $1 billion of these triple net lease properties.
Alan, we have listeners listening to us from all over, and maybe just before we get going, you could define for them what the triple net is and the double net, so that they all understand what you're talking about.
Certainly. Well, let's begin with single tenants, which is rare for the investment real estate world, as opposed to a multi-tenant strip center or shopping center or office building or apartment building. This, as described, is just one tenant, and they range from pharmacies, Walgreens, and CVS, to auto-related. It could be a Jiffy Lube, a 7-Eleven, or Wawa, or Circle K gas station, a Caliber Collision, anything automotive, restaurants, McDonald's, Chick-fil-A, Chipotle, Panera, and all the restaurant chains that you see. Dollar stores, Family Dollar and Dollar General. Larger properties could be a Target or a Walmart, or a Costco is another triple net, Home Depot and Lowe's. So again, one tenant with a long-term lease. Long-term would be a primary term between 10 and 20 years. To answer your question, triple net means the tenant takes care of everything. All taxes, all insurance, all maintenance. If there's a roof leak, plumbing, electrical, HVAC, parking lot, or eventually if one of those need to be replaced, that would be entirely on the shoulders of both financially and to coordinate all the efforts for repair or replacement of any of those items while that tenant occupies the property. If it is a double net lease, it means that some portion of the obligations would be on the landlord's shoulder. Maybe roof, maybe structure, maybe parking lot. Usually the majority of the items would still be on the tenant's obligation list, but a few of the items would be on the landlord's list. And that, again, would be a double net lease.
Yeah, that's typical of a Starbucks property where the Starbucks manager might call you, or the real estate manager might call you and say there's a irrigation that's leaking, or there's a pothole in the parking lot, and the landlord would typically fix that, but then the landlord would charge Starbucks back in their CAM reconciliations at the end of the year. Is that fair, Alan?
In most cases, that's fair. Maybe not in Starbucks. Starbucks is a great company, but they have a difficult lease. Theirs is more onerous for the landlord than you described, but many of them are very much as you described.
So let's talk a little bit about what's going on in the market, because in the investment world, whether it be stocks or strip centers or apartments, it's a feeding frenzy right now. We're experiencing a lot of cap rate compression. Can you give us a 30,000-foot overview of what's going on in the single tenant market?
Yes. The single tenant market, if you take any of the sectors that you described and you pick the hottest sector, it probably would not be as hot as the triple net sector. There's an incredible demand for single tenant, especially triple net leased property. It's considered by most to be the safe haven of real estate, where you often get a Fortune 500 tenant, a very long-term lease, and it's really the only aspect of real estate that's truly passive. Most of our clients come from they would 1031 exchange out of an apartment building or out of a shopping center or other investment property. And what they're looking for different is complete passive ownership, where they just collect a check. People call it mailbox money, where all you do is go to your mailbox once a month and you see your check waiting for you in the mailbox. It's kind of an old expression. Usually it's put into your bank account, but you get the idea. And there's just an incredible demand, and people want these high credit, great location, long-term leased properties
where they have marginal responsibility. It's really a beautiful thing. I know one of the complaints that some of our listeners have, and when they've mentioning single tenant, is how tough it is for the individual investor to get involved. There's the pipeline seems to go with many of the properties to the mutual funds like AEI or the REITs, any number of them that buy up single tenant properties. What kind of advice would you give to an individual investor who might be selling 30-unit apartment complex and says, I really don't want to manage all these tenants anymore. I just want a single tenant, but they've had some frustrations in getting started. What would you suggest to those folks who might be a buyer of a single tenant property?
What I would suggest is working with a buyer broker. I imagine on your call, on your show rather, you spent some time discussing why having a buyer broker is important as opposed to contacting the listing broker whose name is on the brochure.
Yep.
If you do an internet search and you find an interesting property and you call the person whose name is on the brochure, that person has a fiduciary to the seller and no obligation to the buyer. So the first thing I would suggest is working with somebody that is exclusively a buyer broker. And myself being a buyer broker, the real advantage to the client is there's no conflict of interest. And when you're a buyer broker, you don't have any of your own properties. So I work with brokers all around the country, Marcus Millichap and C.B. Richard Ellis, and Stan Johnson and Colliers and all the big national companies and the boutique companies. They focus primarily on listings, and they send me as a buyer broker all of their properties, and I aggregate all the properties for my clients. And at any given time, I have close to 200 properties that we've already vetted and pass certain criteria that we have organized and prepared for our buyers. So the market is difficult, as all markets are right now, because there's so much demand, but I've aggregated all the properties, really the best of the best nationwide, into one simplified platform that I share with my buyers.
Alan, just to expand a little bit on, when you said it's a mistake for a buyer to call the listing broker, what happens when they do call the listing broker? It's often, not always, too late then, right? Because then the listing broker also becomes the procuring cause, and it becomes too late to bring in another broker.
That is correct. What I share with my buyers is that they see a property online or that has been emailed to them. before they request a brochure, before they call the broker and ask questions, send it to me. Just forward the email to me or the hyperlink. I vet the property. I secure I request the brochure and I share the brochure with the buyer. And the listing broker hasn't done any work with that buyer yet. They haven't discussed the property. They haven't began any negotiation. And because we get in early, the listing broker is happy to have me be the buyer broker for that property. And after 29 years, I know pretty much everybody in the industry, and I've closed deals with almost everybody in the industry, and they're happy when I call. It's almost never a problem when the client forwards a brochure to me and I represent them as the buyer.
And let's talk a little bit about and listen, we're all brokers. All three of us are here brokers, and I'm not really trying to show up brokers and say, hey, this is, that you have to come to us and whatnot, but we're just trying to let you know what happens in the real world when you try to do some of this stuff on your own. And me being and dedicating most of my time to doing investment brokerage, you would get these folks who call in and they're going, well, I might want this and I might want that and I might want this big and I might want this little and I want maybe this type of property and this type of property, but they're not really focused. The reality is that part of what a buyer's broker would help the buyer do is get focused so that the sellers and the seller's broker would take them seriously. The reality of the situation is, as you say, this is such a hot market. It's when that buyer who's not 100% certain of what they're doing and how they're doing it, contact a seller broker directly, they're just not going to be taken seriously. And so working with somebody like Alan, who's in the business of vetting these properties, and then Alan is also going to vet the potential buyer, that to make sure that they're focused on what they're going to do so that everybody's in the game with a chance to win. Otherwise, people, this is where the frustration comes in from buyers. They're not focused and they're calling these selling agents and then they just don't get calls back.
Well, that problem is actually exacerbated over the last 10 years because so much more has moved online. The temptation is there for the buyer to see something at 2:00 in the morning and immediately contact the listing broker. It's just become a lot more prevalent.
Oh, there's no doubt about it. But to finish, essentially the thought is if somebody's calling and saying, I might want a Starbucks or I might want a 20-unit apartment complex, that's not going to get a call back from either the apartment broker or the single tenant broker because the person's just not focused.
It's all true. When I submit an offer to one of you guys, we haven't done a deal together, but if I were to submit an offer to you, what you would want from me is to make sure that the buyer fully understands the property, isn't making multiple offers on multiple properties, and is ready, willing, and able. And if I'm able to properly present that to you and show the credibility of the buyer and their intent to buy your specific property, that's just music to your ears. That's exactly what you want, not only to hear, but know is accurate. So when you say to me, tell me about your buyer, and I have a full understanding of the buyer, where they are and if they're doing a 1031 exchange, what they sold, what the closing date is, and knowing if their contingencies have expired, if their earnest money is non-refundable, and I present it in a very succinct way to you as a listing broker, I just made your job much, much easier. And that confidence in not only the buyer, but in how the information has been presented to them makes your job much easier as you present it to the seller. And if you have 4 or 5 offers in hand and one of them is properly packaged and vetted and communicated to you in a way that you want to receive it, and any really experienced broker knows how to package it and convey it properly, you can be the same buyer, but you'd look like a great buyer if presented properly, or one of the many random calls that a listing broker receives that really doesn't get much attention. It makes a huge difference how it's packaged, how it's presented to the seller or to the seller's broker.
And so with your package, do you normally give financials or just some evidence to show the strength of the buyer?
It begins with a letter of intent and an explanation why the buyer is ready, willing, and able to proceed with that letter of intent. I usually don't provide financials or other documentation on the sale, but if it's needed, we obtain it. It's more a letter of intent and a full explanation of why this is the right buyer for this specific property.
Talk to us about finding value in this tough market. How are you doing that? Are there certain brands and concepts on the retail side that you think are good values that you prefer and might be showing to your clients, or there are certain regions that you think might be a little better than others in terms of value? How are you dealing in this tough market, I think, is the short and long question, Alan.
Well, I can take that question in several different ways. So let me first begin with most of the triple net properties have a retail component. I try to focus on properties that both the internet and Amazon cannot replace, and that have done well through COVID. So that's the first place and first direction that we try to find value. We don't want the next Blockbuster Video to be your tenant. We want a property that will be relevant, and a location that'll be relevant, and a tenant that'll be relevant for decades. So that's probably the first place I'd begin.
And how about regions? Are you noticing any difference, or is it all just hyper competitive and priced accordingly?
Regions make a big difference. The two hottest states by far in the country are Florida and Texas, and I sell a lot of property in both of those states. Clearly the hottest sectors. But if you live in a tax-free state, you clearly have an advantage being in one of those states. And there's a great business environment, which is also why people want to be there, even if the buyer doesn't live in one of those states and can't have direct benefit from being a tax-free state. They're just a quality business-friendly, both of them are quality business-friendly states with high growth. But this might sound odd, but I really believe every state has a high growth area within it. One of my clients from California began our conversation when we first met saying they wanted to be in Texas or Florida, like many of my conversations begin. And I suggested they look at all the properties on my list that fit their criteria without judgment. And as they looked through the properties, I explained that every state has that prime retail corridor. Picture the retail corridor with all the national tenants lined up, Home Depot and Kohl's and Lowe's and Target and Walgreens and Chick-fil-A and 7-Eleven and all the national retailers up and down that corridor. And maybe it's anchored near a university or a big hospital or a major highway exit. That's the type of location that I call a permanent location. And we all have states in our mind that we might think would be inferior to other ones or less dynamic. But I assure you, in that state and every other state, there's the city that has that prime retail corridor where all the people shop, where all the money transacts, that you'd be proud to own property in. So rather than try to pick which state, you can give me any city. You guys are based in Florida, in Miami, and a lot of Palm Beach County, and Fort Lauderdale, and Naples. A lot of the big cities are really dynamic real estate markets. But if you just bought by the city, each one of those cities has the right side of the tracks and the wrong side of the tracks. And it's a big difference which side of the tracks that you're on, where the money and the retailers want to be. So if someone said, I'm going to buy a property in Fort Lauderdale, you could end up with a great property, but you can also end up with the wrong property. So again, it's not just which city, it's what part of that city. And most states have that city that everybody wants to be in.
That's a great point. We talk about how hot this Florida market is, but you can still make really bad decisions buying in Florida. there's areas as hot as it is, and areas that are seeing just such explosive appreciation and cap compression. But then not very far away, there's pockets where there's economic deterioration, and I don't think I would own a piece of dirt in some of those neighborhoods, let alone try to make a multi-million-dollar single-tenant net lease investment.
If you're in Miami and you're on Biscayne Boulevard, for the most part, you're golden. But if you're a half block off Biscayne Boulevard, you can be completely off the traffic pattern, and nobody's going to know that you're there. It's really that specific and that detailed to pinpoint the right property in the right location.
Alan, just a question. You were talking mostly about retail, which is where most of the triple net properties are, but medical has become a subset of that market. What are your feelings about the medical triple net market?
Well, it's a great angle within the market. The two national players would be DaVita and Fresenius.
Yeah, kidney dialysis.
And they have, kidney dialysis. Those are the traditional medical triple net tenants. There's also the urgent cares, which I'm a little less bullish on, the urgent cares. I've seen them go a little more frequently than I'd like. There's mom and pop surgery centers, the dental practices. Aspen Dental is another national company too. It's a little outside of where I focus. I've sold a handful of them, more in the Fresenius and DaVita side. But some of the local mom and pop doctor's offices could be nice investments too. It's not where I spend a lot of energy, but I recognize there could be a lot of merit within those submarkets and specific tenants that could do well too.
So I still think that you have to go back to what you said before, which is focus on the location. Yeah, I helped a client acquire a DaVita property. It was a great property. But then guess what? When lease renewal came, DaVita moved, and it was hard to find someone else to replace them.
That's right. It's a more specific use type of tenant, and they're not location-centric. So they don't need to be on the main thoroughfare in order to succeed for their specific use. But if I use the example of McDonald's, and I said to you, think of the closest McDonald's to your home and tell me if it's an A, B, or C location. Or let me ask you, closest McDonald's, how would you rate that location? A, B, or C?
A. It's Kennedy. Yeah.
A. If I said if you can think of the DaVita you sold or other DaVita or Fresenius or mom and pop doctor's office, would you say those in general would be an A, B, or C?
I'd say a B minus or C.
Okay. So let's fast forward 5, 10, 20 years, and let's say that each of those tenants vacated. And now you have your vacant McDonald's and vacant DaVita and vacant mom and pop triple net, formerly triple net doctor's office. Now one was an A and the others you'd aggregate as a B minus. So the question, which has an obvious answer of which would be easier to find a new tenant for and what caliber of tenant would take over that property, you don't have to answer it, but the obvious answer would be that a location from that McDonald's or Walgreens or Taco Bell or other traditional national tenant, much easier to find a new tenant for that A type of location.
Yeah, no question. And the DaVita or Fresenius in that B minus location probably is the ceiling for that location, where that McDonald's location, there's equivalents to McDonald's that could go in there. And that's really, I think, the big difference. You might end up with that B minus or C plus location with a substantively less creditworthy tenant, which is a big deal.
Well, also just for a moment on like a lot of the mom and pop doctors and surgery centers and smaller tenants, it's been a changing landscape. So many doctors are now going to work for these large corporations that it's a little bit more risky. The risk factor's changed over the last few years. It used to be a virtual guarantee. A doctor never went out of business or they were there forever, but it's a little different now.
Yeah, there's a lot of consolidation in the medical space. And President Biden is soon to unveil his healthcare plan, and we don't know what it's going to look like and what will follow and how much consolidation there will be after it's announced and put into place.
Yeah. More changes. I had brokered a number of single tenant doctors' condos. I say doctors' condos, but they're in office parks where they're standalone buildings where a doc was, or an eye doctor or a general practitioner or a dentist or whatever. And then really so many of them 6-7 years later were gone. They were working with the major, this is, post-Obamacare, working with the major, stock exchange traded healthcare providers, and Obamacare had really forced a lot of them out of the market. So, we were left with a situation where we thought we would have a tenant for life, and that changed, and we ended up putting. And now there's revolving doors in some of those locations where there might be an accountant for 3 years, and there's an attorney for 3 years, and then there's another accountant that comes back in, and maybe a construction company. So it's we're still making money out of them, but it's somewhat problematic because many of these doctors, they would be there for their entire careers. They'd be there for 35, 40 years before they rode off into the sunset, and that's what a lot of investors were expecting. Of course, Obamacare changed all that. Alan.
That's right.
There is some big changes in Capitol Hill that are being discussed, and it's going to send ripples. Not just ripples. That's really underestimating. Tidal waves.
Tidal wave.
Yeah, through the real estate industry. Why don't you talk a little bit about what's, the 1031 exchange, which is the ability for an investor to be able to defer the taxes that would pay by buying a piece of real estate. It doesn't have to be a like kind of real estate, but it's real estate. And so they're making these transitions. And then you're also talking about capital gains. So why don't you talk a little bit about what's going on there and what your thoughts are about how this might shake out, what will happen?
I'm happy to. So what's being proposed is every real estate investor's worst nightmare. I strongly encourage you to call your congressman or senator and make a push to not have 1031 exchange disappear. 1031 exchange is the grease in the wheel that makes all investment real estate turn. Let me define it, and then we'll talk about it. When you do a 1031 exchange, you can sell your investment property, buy another investment property of equal or greater value, and defer 100% of your capital gain tax and your depreciation recapture, which means any amount of money that you've depreciated over time. If you don't do a 1031 exchange upon your sale, you have to pay back 25% of that amount which you have depreciated, plus your federal capital gain tax, which is currently 20%, plus your state income tax, if applicable, plus 3.8% for Obamacare. If you add all that up, it's a lot of money in capital gain tax if you don't do a 1031 exchange, which is why most investors who sell their investment property do a 1031 exchange, defer that tax, buy new real estate. There's an old expression that says 1031 till you die. Kind of morbid, but I think the point comes across that you don't want to pay Uncle Sam all those taxes. You want to keep your equity moving forward, and the way you do it when you sell is through the 1031 exchange. The proposal is to take the federal capital gain tax rate, which is currently 20%, and move it somewhere around 39%. I'm not sure that they'll get quite 39. I think there will be a negotiation, but it will end up higher than 20. Let's say it ends up at 30. We'll meet it halfway in the middle. If you sold your property and had to pay 30% federal capital gain, plus state, plus recapture, plus Obamacare, you might have to pay 50% of your sale price, depending on your value. If If you bought a property 20 years ago, an apartment building for $500,000, and you fast forward today, and let's say it's worth $3 million or $5 million. Imagine selling a $5 million property and writing a check to Uncle Sam for $2.5 million. That's what will happen if 1031 exchange disappears.
This always comes up in terms of every new Congress because they have to pay for all these goods and services that they've consumed. And 1031 is a low-hanging fruit because there's no organized effort that throughout that's going to that people will fight it. The reality of the situation is, in the way our government works and the voting system works and whatnot, it's political capital. It's a political roadkill essentially, and this is what occurs. But the interesting thing about it is, even the most the highest taxed countries around the world, our friends and neighbors abroad, understand that if you allow 1031 exchange, it's accretive to taxes. So it's very narrow-minded. It might be a short-term victory for Capitol Hill to pass this reform and get rid of 1031 exchange, increase capital gains, and they've helped to put a finger in the dike of that's leaking out from the deficits that we're going through every year. But the reality is, whether it's Germany or Finland or Sweden, all these much higher taxed countries realize that if you allow not just real estate but business to expand and defer the taxes as they're selling assets, whether it be a manufacturing facility or it be an investor moving from Starbucks to to a CVS store, it helps. It's accretive from an economic activity standpoint. And so for us to try to keep hitting this all the time, it's so short-sighted because it has a dramatic economic downside to trying to curb what you can and can't do on 1031 exchange. But it's something that keeps happening. It's like every few years.
It does keep happening, but one difference is I've never heard it discussed by a president. I've heard it discussed from congressmen and senators, but I've never heard it discussed from a president. And in the State of the Union address, President Biden discussed it directly about the elimination of 1031 exchange. So that's really a big difference coming from the president as opposed to a senator or a congressman. And if they do eliminate 1031 exchange, I think it's important to realize what happens in the economy. And what will likely happen is nobody will transact these appreciated properties. And because the taxes will be so high, people will just hold their property and just keep it. And what happens when you keep it and you don't sell it or exchange it, there's no velocity of money. Velocity of money is an old economics concept that talks about when a property sells, it's almost a butterfly effect. So when a property sells, think who gets paid. You get a real estate broker. You also get a lender. You get a title company. If it's an apartment building, you're probably going to do repairs, so a hardwood floor company, a painter, maybe a kitchen remodel. All of these things happen from one sale. And if that sale doesn't occur, it's a problem. And if 70% of the sales don't happen and people just hold their property, think of the ripple effect through countless industries and the reduction of the velocity of money through inaction and no sales.
It will be more. I've seen the numbers. It would be more dramatic than the 1986 tax reform, which that was the limited partnership when they did in the limited partnership rules, and we ended up in a major recession as a result, and a savings and loan crisis because the lenders were lending based on what tax code was, and they were involved in these projects that the rug got pulled out from under them. This is going to be much more dramatic. Much more dramatic.
So, Alan, given all these changes that are coming, how are investors reacting now in terms of they're worried that we're going to be getting this reduction in, we lose the 1031, capital gains are going up? Are they trying to sell their properties now and do 1031s? Are they trying to buy properties? How are they reacting to the changes they think are coming?
My phone is ringing off the hook from clients and people I know asking, is this really going to happen? And my volume of sales has dramatically increased. And I predict, I might be wrong, but I predict Q3 is going to be twice as much volume as any quarter we've seen in maybe decades. And Q4 might be many times greater than Q3. Everybody trying to get their sale and 1031 exchange in 2021, knowing that they may have to keep their property for decades if they don't. So it's gotten busier, and most real estate brokers are closing more properties now. But I think this is the quiet before the storm. I think it's going to be too busy for everybody to keep up in Q3 and Q4. You know, we all as real estate brokers love the idea of selling more property, but there's a fine line of what is healthy for ourselves and for the marketplace. And I think we might be coming up on a really unhealthy year end for everybody trying to get their sale and 1031 exchange and acquisitions in before the end of the year.
So actually, just thinking it through a little, if this 1031 deal does go away, most likely it'll increase the prices of properties. It'll be very hard to buy properties because sellers will have no incentive. They're just not getting their returns.
It's just going to slow everything down.
They're not getting the proceeds.
Just going to slow everything down.
So So are you saying prices will increase, or I think they'll increase? Because
are you talking about next year and the year after?
Yes.
With the capital gains and 1031 elimination and capital gains increase.
You know, I don't know which way it's going to go. I've had this discussion with several really intelligent and sophisticated peers, and I can build an argument in both directions. I can talk about it's about supply and demand. If demand decreases, then the values can go one direction. But if there's less supply, if that McDonald's developer says, I'm not going to develop this McDonald's because I'm not sure I can sell it. Now we're going to have a supply shortage, and that might cause the prices to go the other direction. I think you can argue it both ways, and I don't know which will be a greater problem, a lack of supply or a lack of demand.
Yeah, my feeling is the supply will decrease. But Alan, let me ask you a question. So if people want to reach you and talk about 1031 exchanges, what's the best way for them to reach you?
Two ways, my phone or my website. My telephone number is 1-800-454-0015. My website is 1031tax.com, 1031tax.com.
And before we let you go, Alan, you had to know that we were going to ask this question before we let you go about the rest of your day. But can you kind of talk to us a little bit about cap rates? And maybe the easiest way to do it is maybe just talk in general terms, pick a single tenant deal, whether it be a Walgreens or a CVS, it doesn't really matter. But kind of give us an idea of like what you've seen over the last 18 months to 2 years with cap rates on that particular asset.
Sure. Well, let me answer it in a couple ways. I think people want to know what the range is. And the range for a quality property, the safest property in the best location with the longest lease, we'll call it your McDonald's or your Chick-fil-A or your Chase Bank, that'll be a 3.5 or 4 cap. If it's a great location, 15 to 20 year lease, absolute triple net. That's your 3.5 or 4 cap. The other side of the range for a quality property, it starts to diminish just around a 5.5, maybe a 6 cap. That is your upper echelon of a cap rate for quality location and tenants in long-term lease.
And what kind of tenants would those be?
Those would be a medium-grade franchise restaurant or a double net lease that has a good tenant but not a great tenant, in a good location but not a great tenant, or not a great location, and maybe an 8-year lease instead of a 15 or 20-year lease, 8 to 10 instead of 15 or 20. There's 3 criteria that really dictate cap rate. There's more, but I can boil it down to 3. One is location, 2 is strength of tenant, and 3 is length of lease. And you can put any property to that test, any triple net property to that test, and understand why the cap rate is what it is. If you see a really low cap rate, you can likely deduct that it's a great location, strong tenants, long lease. When you see a higher cap rate property, we all want a higher cap rate. Of course, who wouldn't want more money? But higher cap rate or higher return is parallel to higher risk. So you have to look at the risk and you look at the reward. And some people are very conservative and they want a very low risk property, and they're willing to take a low cap rate or low rate of return for the security of that very low risk. Some people say, I want a higher cap rate, so they're willing to take more risk. The average cap rate for what I sell is right around 5%, which takes into account the 3.5 and 4 caps and the 5.5 to 6 cap properties, but right around 5% is the average cap rate.
Perfect. Alan, this has been very informative. Love the conversation. Is there anything else you would like to add before we let you go?
Well, I thank you both for your time and your platform, and you do a great service to your listeners. If I can be of assistance, if you have real interest in buying triple net property, I welcome your call. As mentioned earlier in the podcast, I wrote the book on triple net property called the NNN Triple Net Property Book. You can download a free copy on my website. You can buy it on Amazon. I priced it 1 penny over cost, and it's about $4 on Amazon. I didn't do it to make money. I did it to educate the marketplace about triple net property. If you don't want to call me and speak right away, perhaps reading my book would be a great place to start.
Awesome. Alan, definitely appreciate it. Stephen, anything else before we let Alan go?
Alan, thank you very much. Very informative, and we look forward to talking to you soon.
The pleasure is mine. Thank you both.
Thank you, sir. And that was Alan Fruitman talking net lease, single tenant investment property. Stephen, what were your thoughts?
So my biggest thought was the big changes that are coming down the pike, and we don't know, but we have to get ready for them. But for investors and for the real estate market, it could be a really serious outcome. To just think about it, decreasing your proceeds by almost 50%. It's a game changer for real estate investment.
Well, and it's really short-sighted. The data's out. Since about 1911, we've had some form of the 1031 exchange, and every major industrialized country on the planet has this. It's the reason. It's because they actually collect more tax revenues by generating more economic activity by allowing these 1031 exchanges. And they're not called 1031 exchanges, obviously, because that's an IRS code overseas, but it is a deferred capital gains type of a scenario. So I hope that Capitol Hill comes to its senses, although it's never been a place that's particularly has a lot of common sense. It's the least common of the senses in D.C., but let's see what happens and hope for the best. I agree with Alan. If you've not done so yet, please contact your congressman and let him know that this is not good for the country. And I understand the debt is getting out of hand and something has to be done, but this is going to have a worsening effect, not a positive effect on the overall economic base. So, Stephen, Alan was a great guest. Where can we hear other great guests?
So the place to go is to our website, www.investfloridashow.com. You can also download the app on your mobile device so you can listen while you're in the gym or on the road.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Steven Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.